Good day guys, my name is Timothy. Welcome to my YouTube channel. Please, if you haven't subscribed yet, kindly hit the subscribe button below. Thanks. So today we'll be looking at candlestick chart patterns for bullish only, part 1. Watch out for part 2. Alright, so before we proceed, it is important for us to know that we have both bullish, bearish and continuation chart patterns for the candlesticks. So but for the purpose of this video, we'll only be considering the candlestick chart patterns for bullish only. Let's go. So number 1, we'll be considering bullish engulfing. What is bullish engulfing? The bullish engulfing pattern is a 2 candlestick reversal pattern that signals a strong up move. It happens when a bearish candlestick is immediately followed by a larger bullish candlestick. The second candlestick engulfs the bearish candlestick. This means buyers are flexing their muscles and that there could be a strong up movement after a recent downtrend or a period of consolidation. Now looking at this image here, we'll notice that this is a bearish candlestick and this is a bullish candlestick. If you look at the bullish candlestick, it engulfs, as the name implies, engulfing. It engulfs the body and the wick of the bearish candlestick before it showed up. Now there's an assumption that there was a downtrend here. There was a downtrend occurring here, so it stopped here. This was the last bearish candlestick that occurred in the downtrend. Now the next candlestick that appeared, it engulfed the bearish candlestick that showed. This signals that the next movement is an uptrend. Number 2, we'll be considering hammer. The hammer is a bullish reversal pattern that forms during a downtrend. It is named because the market is hammering out a bottom. When price is falling, hammers signal that the bottom is near and the price will start rising again. The long lower shadow indicates that seller pushed price lower, but buyers were able to overcome this selling pressure and closed near the open. Just because you see a hammer form in a downtrend doesn't mean you automatically place a buy order. More bullish confirmation is needed before it is safe to pull the trigger. A typical example of confirmation would be to wait for a white candlestick to close above the open to the right side of the hammer. So looking at this diagram here, there was a downtrend, then this should be a continuation of the downtrend, but something happened. Look at the lower wick. It's long. It doesn't even have upper wick. It means the price, buyers and sellers gained more momentum over the buyers, so they were able to push the price here. So before the close of this candlestick, this one here, buyers now gained the pressure over the sellers, so they pushed the price up to this point. So because it has a longer lower wick, it means it signifies hammer candlestick, and this signifies an uptrend. Number 3, inverted hammer. This occurs when price has been falling, suggests the possibility of a reversal. Its long upper shadow shows that buyers try to beat the price higher. However, sellers saw that the buyers were doing and attempted to push the price back down. Fortunately, the buyers had eaten enough of their Wheaties for breakfast and still managed to close the section near the open. Since the sellers weren't able to close the price any lower, this is a good indication that everybody who wants to sell has already sold, and if there are no more sellers, who are left? The buyers, of course. So looking at this diagram here is just like the previous one we looked at, which was the hammer. This one is just like the inverse hammer, so we call it the inverted hammer. So it's just the same way, but ideally, assuming it was an uptrend, though we'll still be coming to that in our part 2, watch out for the part 2 of this video. assuming it was an uptrend and this kind of candlestick appears and it's red, it's called a reversal pattern. It means there will not be a downtrend next. But now, because of the way it occurred, there was a downtrend and this candlestick appears, so uptrend is evident. The next one we'll be considering is morning star. The morning star is a triple candlestick pattern that you can usually find at the end of a trend. It is a reversal pattern that can be recognized through three characteristics. First, the first candlestick is a bearish candlestick, which is part of a recent uptrend. So this is the bearish candlestick we're talking about. Second, the second candlestick has a small body, indicating that there could be some indecision in the market, which is this candlestick here. This candlestick can be either bullish or bearish, but in this case it is bullish in this instance, which is green. Our green candlestick represents bullish, our red candlestick represents bearish. So the last characteristics is that the third candlestick, which is this one, acts as a confirmation that a reversal is in place, as the candlestick closes above the midpoint of the first candlestick. So this is the midpoint of the first candlestick. It closed above, it opened there and closed there. So this means that an uptrend or a reversal pattern is evident. Okay, we'll be considering person line. The person line pattern is seen as a bullish reversal candlestick pattern located at the bottom of a downtrend. It frequently prompts a reversal in trend as bulls enter the market and push prices higher. The person pattern involves two candlesticks, with the second bullish candlestick opening lower than the preceding bearish candlestick. This is followed by buyers driving prices up to close above 50% of the body of the bearish candle. So this is a 50% of the bearish candle. So this candlestick, it pierced through the 50%, it pierced through the 50% or above the 50%. That's why it's called the piercing line. So because it pierced above the 50% of the bearish candlestick, it means a reversal pattern is evident, which is an uptrend. Last but not the least, we'll be considering three white soldiers. This pattern is formed when three long bullish candle followed a downtrend, signaling a reversal has occurred. This type of triple candlestick pattern is considered as one of the most potent bullish signal, especially when it occurs after an extended downtrend and a short period of consolidation. The first of the three soldiers is called the reversal candle. It either ends the downtrend or implies that the period of consolidation that followed the downtrend is over. So for the three white soldiers pattern to be considered valid, the second candlestick, this is the second candlestick, this is the first candlestick, second candlestick, third candlestick for the three white soldiers. So the second candlestick should be bigger than the previous candlestick body. Infinitesimally, this candlestick is bigger than this, just with a minute change. So also the second candlestick should close near its eye, leaving a small or non-existent upper wick or shadow. For the three white soldiers pattern to be completed, the last candlestick should be at least the same size as the second candle and have a small or no shadow. Thank you for watching this video. Please, as I've said, if you haven't subscribed yet, kindly hit the subscribe button below and subscribe to our channel so that you'll get notifications as more videos are released. Thanks and have a nice day.